Hey guys, welcome back to another episode of TLA. In this video we will show you one of our advanced entry strategies which we have developed using smart money techniques. Order block and order block. Today, we'll take you through a step-by-step process to fully implement this trading setup on any chart, making sure all mechanical rules are followed. This setup starts by identifying an order block as the primary trading zone on the higher time frame. Next, we confirm reversals by analyzing the lower time frames when the price taps into that area. Finally, we trade the order blocks that form along the way until we hit our targets, ensuring high-quality entries. If you're interested in learning smart money concepts, strategy entry reasons, and how to stay disciplined with your trading plan, be sure to hit the like button to support us and subscribe to our channel if you're new. Before we begin, here are two important points about this trading setup. Everything we cover in this video is applicable to currency trading, stock trading, and cryptocurrency. This is because price action tends to remain relatively consistent across different markets. Second, be sure to fully grasp all the steps we'll explain for this trading setup. Before starting to backtest or trade it on the chart, it's important to understand this thoroughly because this trading plan is a structured approach that incorporates multiple trading concepts. This trading plan is a structured approach that integrates multiple trading concepts to achieve the highest level of accuracy. Now, let's dive in. This trading plan is based on three key time frames. First, we have the daily time frame, where we'll conduct a general analysis, review market structure, identify key levels, and assess the space available before reaching a significant higher time frame level. Next, we use the 1-hour chart, where we apply smart money concepts to determine market direction, liquidity levels, fair value gaps, and most importantly, the order blocks. These are the optimal trading zones that could offer us a high-quality setup. Finally, we zoom in on the lower time frame, the 5-minute chart, to find confirmation and enter our positions. Remember, this trading plan is not restricted to any specific chart or time frame. However, it's crucial to use a combination of time frames to analyze market factors and gain a comprehensive view of market conditions. Step 1. Higher time frame analysis. In the higher time frame, our goal is to understand the broader market context so we don't trade blindly on the lower time frame charts. To keep it straightforward, we concentrate on identifying key levels on the higher time frame and evaluating how much space remains before price reaches the next significant level ahead. These key levels follow specific characteristics. Below are some of the top criteria based on price action. The opposite colored candles. When analyzing the trading chart, you'll often observe that an opposite colored candle within an impulsive move tends to serve as strong support or resistance. These candles are commonly used by institutions and large market participants as reference points to refine their trading strategies. That's why we always mark these candles on the chart, especially on higher time frames, and prepare for a potential market reaction at those levels. Fair value gaps. When price taps into these key levels, fair value gaps become highly relevant. If you trade using smart money concepts, spotting fair value gaps should be one of your top priorities the moment you open a chart. Your eyes should go straight to them. But why are they so important? These gaps signal that major players have stepped into the market and caused significant price movement. The market often revisits these zones to fill unexecuted orders, and if pending orders still exist, the price will typically reject upon multiple retests. Multiple rejections. Multiple rejections from a specific level indicate that traders have responded to that price point repeatedly, reinforcing its significance. Although repeated rejections can strengthen a level, they do not ensure it will hold indefinitely. When the market revisits such a level, we closely analyze the price action to gauge the reaction. If the intensity of the rejections fades over time, the likelihood of a breakout increases. On the other hand, if the level is retested and continues to hold, it establishes itself as a strong support zone. Major levels of market structure. A major level of structure is a zone where three key conditions are fulfilled. It has faced multiple rejections, has functioned as both support and resistance, and has been recently respected by price action. When these factors align, we classify the area as a major structural level with a strong potential to trigger significant market reactions. The more criteria a level meets, the higher the probability of another rejection upon retest. By identifying and marking these key levels on higher time frames, we gain clarity on how much room price has before approaching the next significant level. Now, here's an important point. The most reliable way to secure profits in the market is by trading within the empty spaces visible on the higher time frames. These zones, free from immediate obstacles or key levels, offer cleaner price movement and reduce the chances of unexpected reversals. The reason is most instances of price manipulation tend to happen near key levels. Let me break that down. These areas attract a lot of attention from both retail and institutional traders, making them hotspots for liquidity grabs, stop hunts, and false breakouts. Understanding this helps us avoid getting trapped and positions us to trade more strategically in cleaner zones. Imagine this line chart represents our daily time frame. This chart illustrates our daily time frame, where the most recent key level lies well ahead of the current price. This gives us a clear range, plenty of room for price to move, making it an ideal environment for entering long positions with greater confidence. There are no immediate resistance zones obstructing price movement, at least from a technical analysis standpoint. However, things change near key levels. These areas are notorious for multiple breakouts and fake outs before the market finally commits to a direction. This kind of price manipulation is common. It's designed to trap traders who rely heavily on traditional support and resistance concepts. Often, once the manipulation is complete, the market shifts into a distribution phase so quickly that it skips giving a proper pullback or entry opportunity. In conclusion, focus on trading in the open spaces between major key levels on the higher time frames. This improves your probability of catching clean, high-quality moves. Now that we have analyzed the higher time frame, it's time to shift our focus to the 1-hour chart and implement smart money concepts. In this phase of the analysis, we'll examine the market structure to identify the prevailing direction, locate fair value gaps, pinpoint zones of liquidity, and most importantly, highlight order blocks. These order blocks serve as prime trading zones with the potential to deliver high-quality trade setups. The first step is identifying market direction. Trading in sync with the dominant market bias significantly boosts our win rate. To determine the direction, we look for break of structures, BOS, changes in character, CHOCH, and recognizable reversal patterns on the chart. If the market direction isn't clearly visible on a given time frame, it's wise to skip that pair. Ambiguity in trend increases the likelihood of poor trade decisions. By moving to a chart with a more defined trend, we position ourselves for smarter entries and improved risk management. Next, we locate liquidity zones on the chart. In our analysis, traditional support and resistance zones, especially areas with equal highs and lows or repeated rejections, are considered liquidity zones. Why is identifying these zones so crucial? Liquidity drives market movement. Price naturally gravitates toward areas rich in liquidity, and once that liquidity is absorbed, it often moves away from those levels. Recognizing when liquidity is being taken, particularly before price approaches a prime trading zone, adds an extra layer of confirmation to our analysis. These zones can also lead to sharp rejections, so it's smart to lock in partial profits before price touches them. The final step is spotting fair value gaps and order blocks, our main trading zones. A fair value gap is the void between the wicks of 3 consecutive candles on the price chart. The candle responsible for forming this gap is also marked as an order block, since it reflects the moment significant market decisions were made. This zone highlights a buy-side imbalance, where aggressive buying overwhelms selling, often signaling institutional involvement. When price moves through this inefficient phase, it generally returns to the fair value gap area to patch or fill it. For safer entries, wait until price re-enters the order block zone before initiating a position. For even greater precision, zoom into lower time frames, watch for reversal confirmations, and then execute your trade. We'll explore that next. The final step in this trading plan is to drop down to the lower time frame, wait for confirmation signals, and then execute the trade with precision. After the price enters our trading zone, we look for confirmation that the short-term downtrend has ended and the market may be ready to move upward. To identify this potential reversal, we focus on liquidity sweep patterns and changes in character. A valid liquidity sweep below the recent low often signals a possible shift in direction, and if the price breaks above the recent high, we consider it a confirmed change of character. Once this reversal is validated, we move forward with the trade setup. We wait for the market to form a new order block. This is the foundation of the order block within an order block strategy. It's important to note that this lower time frame order block doesn't have to be located inside the higher time frame order block zone. After identifying the order block on the lower time frame, we place a buy limit order at the beginning of the order block and set our stop loss just below it. For trade management, we secure partial profits and move the trade to break even once we reach a 1 to 2 risk to reward target. The next target will be the nearest key zone on the higher time frame. Before jumping into real chart examples, let's first go over a few common chart scenarios and how to navigate them. Would you like a visual diagram for this strategy setup? In the first scenario, where the order block zone is very narrow, it's advisable to use a slightly larger zone for your stop loss placement. The reason is simple: tighter zones are more vulnerable to minor market fluctuations and stop hunts. By widening your stop loss, while still keeping it logically placed just beyond the structure, you give your trade a higher chance of survival, allowing the market some room to breathe without prematurely taking you out. In contrast, when there's a sizable order block zone on a lower time frame, the challenge is that placing our stop beneath this zone results in a wide stop loss. To manage this, we can either use a smaller zone just below the order block as our stop, or position our entry around the midpoint of the zone. This method can greatly enhance our risk-to-reward ratio if the trade goes in our favor. In the third and most crucial scenario, we identify several order blocks before price reaches our target. We'll trade each valid order block the market creates along the path, as long as they present favorable risk-to-reward setups. These entries will be taken with minimized risk exposure, so avoid placing trades that risk over 2% of your capital, and never maintain more than 3 open positions at once. Keep in mind, our main goal is to close the day in profit. Missed opportunities and losses are part of the process. After conducting backtests on this strategy using the euro-dollar pair during the London and New York sessions, we've observed numerous recurring market behaviors. Although this isn't a real-time chart example, it reflects typical market movements and our response strategy. On the 1-hour chart, we can clearly see a steady upward trend, so our bias remains on the buy side. The most recent price action has produced several fair value gaps, so we highlight the candle preceding the imbalance as our key trading zone. The main concept is to wait for the price to revisit this zone, then switch to lower time frames to seek confirmations before executing long entries. But before proceeding, let's review the higher time frame to ensure our analysis is in line with the overall market direction. On the daily chart, it's evident that the market has recently pushed above a key resistance zone, signaling strong bullish momentum. Moreover, there's still considerable room for price to move before hitting the next major level above. This confirms that our 1-hour chart outlook is in agreement with the daily time frame. Now returning to the 1-hour chart, as mentioned earlier, we must wait for a retracement into the order block zone, and then shift to the lower time frames to identify signs confirming a bullish reversal before entering. So let's switch to the 5-minute chart. On the 5-minute, the market has already shown a change of character, which serves as the reversal cue we were waiting for. This suggests that the short-term bearish trend has ended, and we can now confidently look for long setups. The next step is to wait for price to establish order blocks and execute long entries. Here, we see an order block formed, so we initiate a long trade. As the market continues upward, another order block is created. Without closing the first position, we place a second long trade at this new zone. This strategy is crucial because price may skip the initial order block and only revisit the second one before moving higher. In the worst-case scenario, price could decline and trigger losses on both trades, which is why maintaining reduced risk per entry is essential. Now let's observe what unfolds. Price hits the stop loss on the second trade while the first trade remains active. Once again, we identify a fresh order block, and without closing the existing position, we place another long trade at this new zone. We repeat this method until price reaches our target, which aligns with the previous high on the higher time frame. While this strategy has shown consistent profitability, it's essential that you carry out your own backtesting before risking actual capital. This is the reality of trading. Even with a solid plan, you'll face losing trades. That doesn't always imply your analysis was flawed. The most important takeaway is to document your trading rules and stick to them. If you continue to follow your risk management strategy, you'll stay on the right track. So that wraps up today's video. I hope it brought value to your trading journey. If it did, make sure to hit the like button to show your support, and if you're new, don't forget to subscribe to the channel. Catch you in the next one.